Okay, great. So time to restart back. I'm very happy to chair this session with two amazing papers. My name is Tomas Williams, for those of you who don't know me. And first up, we have Chang presenting Inelastic financial markets and foreign exchange interventions.
Good afternoon. Thanks for sticking around on this Friday afternoon. I appreciate your presence. So I'm Chang from University of Virginia. I'm really new. I just joined literally a month ago. So I'm very new to the profession. Well, nice to meet everyone. So today we're going to talk about inelastic financial markets and foreign exchange interventions. Foreign exchange interventions, typically defined as the central bank buying or selling international reserves through the open market operations, is a key policy tool for the central bank to intervene with exchange rates. Intervention typically happens, can happen both in financial crisis and normal times, and they come in large magnitudes. Given how frequently used and how large-scale those interventions are, a key policy question to ask through the lens of macrofinance perspective is, do these interventions work at all to stabilize exchange rates? If you look at the traditional macrofinance models, and that's the kind of model we teach undergrads and also from the textbook, Mendel Fleming type of framework, there's also in the first year macro PhD sequence. So those models assume that financial markets are perfectly elastic, in that home and foreign assets perfect substitutes, and that uncovered interest parity condition holds. In this regard, intervention will simply be reshuffling assets between home and foreign households and would therefore have no impact on exchange rates at all. However, the asset pricing literature predicts otherwise. They say that the home and foreign assets are far from being perfect substitutes, and the financial markets are far from being perfectly elastic. Therefore, from an asset pricing point of view, we have reasons to believe that interventions do have traction on exchange rates. With this controversy in mind between macro literature and asset pricing, let me introduce the research question of this paper, which is exactly how effective are interventions that stabilize exchange rates? Well, it turns out it's actually a really challenging question to ask empirically, precisely because intervention in exchange rates macro fundamentals are jointly endogenous. If we were to run the regression of exchange rates on the size of intervention, well, such regression will produce a zero coefficient, for example, if the intervention really stabilizes exchange rates perfectly, right? Because the simultaneous supply-demand bias of OS in this estimation. Therefore, to causally unravel the effects of intervention on exchange rates, we need a natural experiment where there's a currency demand shock that exogenously shift the currency composition of government bonds in the economy and affects exchange rates while being orthogonal macro fundamentals in the economy. So here I also highlighted the words currency composition because I want to highlight that this is we are differentiating between buy and sell. We want a shock on just one currency versus the US dollar. So what do we do in this paper? We asked the question, how effective are foreign exchange interventions to stabilize exchange rates? To answer this question, we leveraged from the mechanical rebalancings of the largest local currency government bonds index for emerging countries. So this index called GBIM, which I'm going to speak about in detail in a few slides. We show that mechanical rebalancings create exogenous currency demand shock that moves exchange rates but are orthogonal macro fundamentals in the economy. And evidence provides support that financial markets, or in particular the foreign exchange markets, are inelastic. Through this natural experiment, we identify the elasticity of exchange rates in response to the currency demand shock. And then using a model of inelastic financial markets, we recover or identify the required size of intervention counterfactually to stabilize exchange rates. There are a few interesting findings of this paper. Number one, we find the currency demand shock that moves exchange rates significantly, both in the short and long run. In the short run, a 1 cent deviation of the shock moves exchange rates for about 1.2%. This is for median country sample, and a 1 cent deviation shock is about 0.6%. Okay, I don't know what's pointing. Okay, so 0.6 billion is a small number for maybe the G10 countries or the US, but it's actually a rather big number for the emerging market sovereign bonds market. The 0.6 billion is about the size of a monthly issuance sovereign bonds for a median emerging country in my sample, such as Colombia. And we show that such effect is not transitory. It actually lasts for about 3 months. In other words, it's rather persistent, which we can draw policy implications. The fact that exchange rates are responsive to this currency demand shock provides support that financial markets are inelastic. And under inelastic financial markets, foreign exchange interventions, we show that can effectively stabilize exchange rates, independent of monetary policy, and also regardless of capital control policies. In other words, this whole framework provides support that breaks down traditional trilemma condition, or in other words, relaxing the trilemma condition from Mendel-Fleming. Finally, if you want some numbers, we find that the average size intervention to move the exchange rate is about 0.1% GDP for median for the average effects in our sample of emerging countries. And we find that more inelastic financial markets are, and in our case, the more floating the regions of exchange rates are, the more effective interventions are. And by effective, I mean that you require less amount of reserves, US dollars, to move the exchange rates by the same amount. All right, so the rest of my talk today is going to be divided into 3 blocks. Number 1, I will introduce the currency demand shock, or that's a natural experiment. So hopefully convince you that our experiment is identified and exogenous. And secondly, I'm going to speak about the dynamics of exchange rates in the currency markets and how it's relation to the interest rate and exchange rates. And finally, I will show you a very brief model of inelastic financial markets and draw policy implications about foreign exchange interventions. Okay, so here we start. We use this index called GBIEM, Global Diversified. The full name is Government Bonds Index Emerging Market Global Diversified. It is the largest emerging market local currency government bonds index in the universe or globally. By largest, I simply mean in terms of assets management. So in 2019, the assets management for these funds, this index per se, is about $200 billion US dollars. Again, this is a big number for the emerging market economy because $200 billion is actually about the size of a total issuance sovereign bonds for the emerging market, all the emerging countries combined in the same year. Another way to look at the popularity of this index is to go to EPFR dataset, which, as many of you know, is the leading mutual fund data provider in the world. So if you go to EPFR and you count all the mutual funds who are tracking a government bonds index for emerging countries, you'll see about 90% of them are tracking a version of GBIEM, okay, which again adds to the popularity of the index. Well, now, the crucial thing in this paper relies on the identification strategy of this index, which happens at monthly frequency at the last business day of month, where JP Morgan caps the weight of each country at 10%. Okay, how it's being done, I'm going to be very specific in the next slide. Just bear with me. I'll give you an example on that. But before we do that, let me just bear with me with some notations. So we have QT, which is the actual sovereign bonds outstanding, and we have QT hat, which is how much JP Morgan choose to include in the index. So again, QT is actual data, and QT hat is what JP Morgan choose to include in the index. So larger the countries, the larger the QT, larger sovereign bonds market, the larger the QT hat, JP Morgan will include in the index, but this is something they chose mechanically. And the larger the weight of a country. So Brazil, in my index, is a much bigger country, but have a much bigger weight than, let's say, Peru or Argentina. So now this rebalancing mechanism caps this weight of the index, which is constructed using QT hat, at 10% at the rebalancing date. So what it does is that if I wake up today at the rebalancing date, I saw Brazil's weight is 15%, I have to mechanically reduce Brazil's weight from 15 to 10, and then I have to redistribute the residual weight of 5% of Brazil from 15 to 10 to the other smaller countries not at a threshold, so that everyone's weights add up to 100%. Well, therefore, in this rebalancing event, some countries' weights increase, the others decrease, meaning that the mutual funds for tracking the index would have to passively buying or selling their shares or portfolios or their positions, simply to mimic the rebalancing mechanism or this portfolio weights in the GBI-YAM index, leading to capital flows across countries and moves exchange rates. To capture this currency demand shock, we try to denote this, change in capital flows through introducing this notation called mu-CT, which I call my currency demand shock. It's constructed using weights before and after rebalancing. Okay, it doesn't work. Before after rebalancing, just moments before and after rebalancing occurs. So there's weights before minus weight after divided by weights after rebalancing itself. Why adjusting by the country's weights after rebalancing? Why dividing by country's own weights? Because a $2 billion US flow for Brazil will be very different for, let's say, Argentina, right? So we want to reflect the country's own size in the denominator to count for different sizes, the market size of the country. Okay, so the next slide, I'm going to be very specific about how we construct these weights and how the rebalancing is done. So here we have the weights before and after rebalancing happened. Again, these are the same. These are the weights on the same date, moments before rebalancing occurred and after. The weights before using the rebalancing weights from previous months. So QT minus 1, Q hat minus 1, T minus 1. In other words, is the weights from last rebalancing, which is I'm rolling it over until this month, so I'm adjusting by the returns of this month. So in other words, the omega before is the weights of rebalancing at a rebalancing day before rebalancing occurs. In other words, it's the passive buy and hold weight of the country if rebalancing does not occur. Then there's this omega after, which is weights after rebalancing. It's using the QT hat after rebalancing finish, and also the new QT hat, which is the new face amount JP Morgan chose today after rebalancing. So importantly, I'm just going to say this again. So this wave before and after rebalancing, these two things here, captures the moments of rebalancing before and after rebalancing happens. And importantly, they're conditional on the same macro fundamentals and the same price because they happen on the same date. And the only difference is like moments before and after rebalancing occurred. So let me give you a rebalancing example, like simplified, okay? So let's just imagine for simplicity, we have 11 countries in the index for simplicity, and 8 of them already at a 10% cap. So we have another 20% of them who are not at 10% cap. I'm just listing them here. So they're Brazil, Colombia, and Peru, okay? So this is the ways, this column here is the ways of rebalancing at a rebalancing date before rebalancing occurred. So think about, so how do we get here? Well, think about Brazil is doing really well this month. Brazil is having macro fundamental shock. Its price is booming. Its returns is increasing. I wake up today, I'm JP Morgan, and I realize Brazil's worth 15%, and Colombia is 4%, and Peru is 1%. Well, what can I do? Well, by this mechanical rebalance rule, I have to mechanically reduce Brazil's weight from 15 to 10, right? Because the cap says you cannot go above 10%. And I have to reshuffle this 5% from Brazil to Colombia and Peru mechanically, well, proportionally, because, their own weight is 4-1 in the original column. So I have to shuffle this 5% from Brazil to Colombia and Peru, so that all the countries' weights are either at or below 10% threshold. So here, I'm just a very simplified example, but in reality, this rebalancing could go recursively for many, many rounds until all the countries' weights are either at or below 10% threshold, and we're in the second column and we are done. So this is how it works in a simplified way, but in reality, those, it could take multiple rounds, but it happens instantaneously. All right, but let's pause for a second and revisit or summarize what we have seen here. So here we have seen a macro fundamental shock for Brazil that leads to Brazil's price increase and returns increase. So Brazil hitting 10% threshold. However, such fundamental increase in Brazil's macro fundamentals leads to Colombia and Peru rebalancing in ways, well, not because they're doing better macro fundamentally, but mainly because, or only because Brazil is hitting 10% threshold and have to rebalance downwards. So this country brought up their weights, meaning that Colombia and Peru have to bring up their weights, not because they're doing better macro fundamental in their own country, but purely because Brazil is having a macro fundamental shock in Brazil's economy. In other words, the countries who are not at rebalancing cap, that is the Colombia and Peru in this table here, their change in their weights are subject to the own macro fundamentals in their country. And that's the key identification assumption we're exploring in this paper, that we're using the changing weights of countries not at a 10% threshold, and we're claiming that their changes in weights, which drives capital flows and exchanges movements, are independent macro fundamentals in their country. Okay, here we want to have a quick comment here. So even though I coincidentally chose like the three LATAM countries here, like which is Brazil, Colombia, Peru, but in fact in my sample, there's 70 countries, and they differ by their geographical locations. There's also like Turkey, Thailand, and South Africa, and also, yeah, so there's not just LATAM countries in a sample. So just rest assured that this country very different macro fundamentals and co-movement in their monetary and fiscal policy. There are a lot of variations in a time series, okay? So even though I just only chose 3 LATAM countries here in this example. All right, so hopefully for now I've convinced you I have a rather exogenous shock in the currency market. So now I want to show you how this currency shock from this natural experiment moves exchange rates and interest rate. So the first fact I want to show you is that this currency demand shock moves exchange rates in the short run. So here we have this graph, which is the vertical axis, exchange rate change, and horizontal axis is the horizon, the days before not rebalancing, where time 0 is rebalancing date, it's in the middle, and just extending the window all the way to the left, which is a month before, and then and also months after. Why are we going back to months before? Because rebalancing happens monthly frequency. So here I want to capture the cumulative change with change since the last rebalancing happened, and all the way until this rebalancing occurred. So we show that exchange rates, which defined as dollars, local currency per dollar, it appreciates, so it drops in value, means appreciation here, in response to a currency demand shock, exactly as we would expect it, right? Local currency appreciates as the weights increase. Well, there's another thing, as some of you guys probably have noticed, is that why is exchange rates moves before the rebalance date occurs, which is time 0? Does it violate the exogenated consumption in this paper? Well, the answer, I believe, is no, because number one, why is this happening? Because the mutual funds investors are really smart. They typically have some understanding that, oh, Brazil's going to hit 10% again, so everyone else is going to get some spillover weights increase. So they typically do expect that weeks in advance, because they can see the news, they know the macro fundamentals. So that's why exchange rates, just as other asset price variables, they start moving weeks before the actual balancing happens. And in fact, if you take a closer look at my table, all the information effects kick in before the rebalancing occurred. At time 0 and after, there's no more additional movements of exchange rates. In fact, after time 0, all the residual effects information are gone, because there's no more information revealed to the financial markets to push exchange rates even further. It is also because exchange rates are moving weeks before the actual balancing occurs. In estimation, we take the entire window, by entire window I mean weeks before rebalancing occurred, all the way back to the months before, and then all the way to the months after, we take the entire window of horizon of estimation to as our elasticity of exchange rates movement in response to the currency demand shock. So that's in the short run. We also do the same regression, but we try to extend the table horizon much longer, and we find that the effects are rather persistent. Well, the lion's share effect has come in the first months, but after the first months, the effect does not go away right away. It lasts for about 3 months significantly until almost 1 year when in fact purely goes away, meaning that the exchange response are significant to one currency demand shock. Okay, it's not entirely transitory. This again appeals to the slow capital movement argument in finance, even though this profit is left on the market and takes time for the capital markets to respond to arbitrage away the profits on the table. One concern that could potentially invalidate my identification is that what if monetary policy rates are responding? What if central banks see this exchange rate movement, they're going to jump in and do something to offset exchange rate movements? If that happens, it could invalidate my identification. Well, the answer is that, well, this is not a possibility because we do check the policy rates and also the yields in my framework do not respond to the currency demand shock. Okay? In other words, central banks are not actively using monetary policy rates as a policy instrument to offset in the exchange rate movements driven by the currency demand shock. And finally, we want to understand if there's heterogeneous impact of exchange rates in response to government currency demand shock. So here we take the same regression as we had in Fact 1, but rather than doing a pool regression across countries, here we do a country-specific estimate. So this beta is now country-specific, indexed by country C. Okay. We want to understand if there's country variation of response across countries, and we want to also understand that if there are, what's the driving factor of that? We tried a bunch of things like inflation, consumption, macro fundamentals, and there's only one, well, maybe two measurements that really show up to have strong correlation with the country-specific exchange rate response, and that is the exchange rate regimes or the volatility of exchange rates. So here I have a figure showing the response of exchange rates to the currency demand shock. That's the vertical axis. So the more negative the shock, the larger the response. Okay. And the horizontal axis is the regime of exchange rates classified by this Rogoff and Reinhardt framework, Yosaki Reinhardt-Rogoff framework, all the way from de facto peg in the left to free floating. So you can see there's a very clear downward sloping trend. The more inelastic financial markets are, or the larger the response of the exchange rates to a currency demand shock, meaning that their financial market is more inelastic, the more floating the regimes are. And also we used the size of a circle as a volatility exchange rate. So the more inelastic financial markets are, so the larger the size of a circle. Okay, so in the last few minutes, I'm just going to do a very simple model to rationalize what we have seen. So let's pause for a second and review what we have seen here. So we see this exogenous currency demand shock that's independent macro fundamentals. We also see that this currency demand shock moves exchange rates both in the short and long run, but do not move monetary policy rates. In other words, this already breaks down UIP condition, right? Because you move exchange rates, but not interest rate. In addition, this shock have heterogeneous impacts across currency regimes, and this heterogeneous impact depends on the regimes of exchange rates and volatility. So therefore, we need a model where there's a currency demand shock that impacts arbitrageous holdings through market clearing condition and leads to deviations in UIP, but in a endogenous way. And this response depends on volatility of exchange rates. So that's the kind of model we will need to have in mind to rationalize what is empirical findings. So here we have this model, which is, I'm just going to only present two equations here for the entire model slide. We have one equation, which is arbitrageous holdings, with simply just these arbitrageous holdings for country C, and these holdings is a function of UIP deviations, which is given by the difference between exchange rates and interest differentials, home and foreign currencies. And then we have the exogenous UIP shocks, which is a risk premium shock, the phi CT, and the capital control shock tau CT. Why do we call the exogenous UIP shocks? Because those are the shocks that have no impact on the equilibrium allocation of assets and exchange rates. So they act on as return differentials on interest rate differentials, okay? But they do not change the equilibrium properties of the exchange rate markets. And importantly, we are capturing this lambda CT with the risk-bearing capacity arbitrageurs as a function of volatility exchange rates. So it's a function of sigma square E, which is volatility exchange rates. So I said two equations. The second equation is just the market clearing condition. So we have 4 agents in the model. We have the home and foreign households. So that's the B. We have government interventions, and that's the F in green here. And we also have noise traders, okay? And also we have arbitrageurs holding, that's D. So noise traders, they are the guys who are subject to liquidity demand shocks, who are orthogonal to macro fundamentals in the economy. Okay, exactly like what we had in our empirical framework, where we have those currency demand shock, which also moves exchange rates, but independent macro fundamentals. If we substitute the second equation to the first one, if you put in the arbitrageurs holdings, the second one to the first one, and everyone can do this in simple math, you can rewrite the first second equation as a modified UIP equation that's in my third line here, which the exchange rate movement today to tomorrow is a function of interest differentials plus exogenous currency demand shocks, exogenous UIP shocks plus these arbitrageurs holdings, which I just call the whole thing, the endogenous UIP shocks, because those are the shocks that will lead to endogenous deviation in uncovered interest parity condition. Well, think for a second, what we have done earlier is that we estimated exchange rate response to the currency demand shock. In other words, we're capturing, if you're mapping the data to the model, we're essentially capturing the lambda CT, right? Because NCT is noise trader shocks, and that guy is moving, so we can so what we're estimating in the data is essentially lambda CT. What else can we learn from lambda CT, the risk-bearing capacity? Well, if we understand what's lambda CT, we can also understand what is the counterfactual requirements of intervention from the government to stabilize exchange rates. Because identifying lambda CT would mean that you also understand what counterfactual F would need to be, which is the foreign exchange intervention size need to be to offset noise trader shocks and to eliminate UIP deviations equilibrium. And that's exactly what we're doing in empirical estimates. So we try to take this estimate, try to understand what a lambda CT is for different currencies in a sample. All right, I know I have just 2 minutes, so let me just be really quickly here. So what have you learned in the policy implications? So far we found a currency demand shock. We show that moves exchange rate, but not interest rate. And we show that interventions are potentially effective, or they are effective because the financial market is inelastic. And we have shown that intervention can be effective regardless of monetary policy rates and capital flows, control policies. In other words, our framework provides support for relaxed trilemma condition, which is in contrary to the classical trilemma condition that's adhered to textbook model of Mendel-Fleming, which says you can only have 2 of the 3 of these conditions here, right? However, under our framework, you can have 3 of the 3, because now financial markets are inelastic with endogenous UIP deviations. Intervention from the government can now act as additional policy instrument to effectively stabilize exchange rates without compromising monetary policy rates and regardless of the capital control policies. In other words, this new framework relaxes the classical trilemma constraint from Mendel-Fleming. Where does our paper stand in the broad string literatures? So if you put all the UIP papers into 3 broad baskets, you can have the first strand, which is from the Mendel-Fleming. That's the UIP condition holds. And then you have the papers where UIP are subject to exogenous demand shocks. And then we have our framework, which is also aligned with Quebec's majority, Sokimukin, and also Gita Gopinas and Costas' new papers. They propose an endogenous UIP framework where UIP deviation comes from a currency demand shock, and also it is only under this framework that the trilemma condition holds in a relaxed way, and we have the interventions from the government can can stabilize exchange rates. All right, so let me just, one slide, I'm going to conclude. So we have some numbers we find. So we do find that the elasticity of exchange rates of the markets really impact the effectiveness of interventions. And here, for example, the floaters are much more effective at moving exchange rates. So, for example, South Africa free floater is 3 times more effective at moving exchange rates than Peru with a crawling packer. And so the Lancer model is because the more floating you are, the further departure you are from the trilemma. And if you are exactly pegged, your exchange volatility is 0, you're back to the trilemma constraint or Mendel-Fleming framework, where intervention does not work at all, and that's when the financial market is elastic. All right, so let me conclude. In this paper, we use a well-identified demand shock that moves exchange rates. Independent macro fundamentals, we show that such demand shock moves exchange rates both in short and long run and have heterogeneous impact across countries. We then leverage from Inelastic financial markets model to draw implications on size intervention for a range of different emerging market economies. Our paper speaks to different trends of literature, including macrofinance and intervention policies for emerging countries. Thank you very much for listening.
Thank you, Chang. So, to discuss, we have Alessandro Rebucci. Thank you.
Good afternoon, and thank you, Sergio and Tomas, for hosting all of us here and for inviting me to discuss this paper, which I really enjoyed and I really like. So let me start with a little story. When I was in high school, I used to read the newspaper driving to, actually at the beginning of college, going to college, and I used to read the newspaper from the back, because that was a way for me to pick on the important news. And I kept that habit, and when I do referee report discussions, I do the same. First I read the paper, then I go back to the introduction and the abstract, and I see whether my reading of the paper stack up, how does it stack up against the way it is pitched. So I very much like the content of this paper. I think it's great. I am not sure I would frame it in the same way. So let me tell you what I think the paper does from my reverse reading perspective, and then share with you a few comments. So here we are fully aligned. The paper identify this currency demand shock, exploiting index rebalancing rule of the JP Morgan EM Global Diversify. The methodology has been around for a while, but here is executed masterfully on exchange rate. Then it quantifies significant responses of exchange rate to this currency shock, and I agree with Chang that we can think about this as as an experimental setting in which we can make statement on whether or not foreign exchange rate is effective in principle. Then there is an interpretation of the evidence in terms of the inelastic market hypothesis of Gabix and Maggiori, and other models like the one by Dimitri and Oleg with endogenous UIP, inconsistent obviously with the standard UIP condition and with model of exogenous UIP. And then there are some quantitative statements on foreign exchange intervention. So this is the meat of the paper, and I think it was in the presentation. We are very much aligned. I have 3 sets of comments, one on one particular set of empirical results on the anticipated effect of the shock, some quibbles and some suggestions. I don't think that is important because it can be easily addressed. And then there are some statements in the paper which, from my reverse reading of the evidence, some of them seems to me redundant in the sense that yes, we can make them. They are not. But I'm not sure they move our understanding of the problem forward. There is one set of statement I think is circular, and I'll stop here for a second. So here, market segmentation, not only UIP deviation, but market segmentation is endogenous because we have exchange rate volatility. So if intervention squash volatility, it also squashes the segmentation. So I have a hard time understanding how we think about fixed exchange regimes having intervention that is ineffective. Because you shut down exchange rate volatility, markets are no longer segmented. The question there no longer has meaning from my perspective. Similarly, on the trilemma, it's not that the intervention per se breaks a trilemma. It is exchange rate volatility, is the flexibility that segment the market and gives scope for intervention in that setting. So there, I think there is more of a substance. And these things would come up more clearly in a fully specified general equilibrium model. And then a couple of broader questions where perhaps this agenda can be taken forward. So this is the main results of the paper, is the response of the exchange rate to estimated shocks. And very interestingly, not only we can see the dynamic response a month after the intervention, but can also see anticipation effects. If these are correctly estimated, it's very interesting because not only we get the response of the variable to the shock, but also the response of the expectation of the variable. So it's potentially very valuable information. I agree that the rebalancing methodology give us a currency demand shock that are orthogonal to domestic fundamentals. But in this regression, there are only the countries that are not at the cap, right? And there is a common effect. So what we're controlling here at every date of at every point in the data set, the common shocks among the small countries that have not rebalanced. We have not controlled common shocks between the countries that has been pushed against the cap before the cap kick in and the countries that are rebalancing. So in this part of the impulse response, I am not able to separate with the time effect the two treatments that are going on. The factors that are more likely not to be common that push the large economies against the cap, and then the anticipation of the cap. The good news here is that this can be easily addressed because if I understand correctly, the specification has only the dummies, so the vector of x control variable is only dummies. It could be easily extended to include measure of the global financial cycle, the commodity cycle, the war business cycle. So I would put those three things, global growth, commodity index, and measure the global financial cycle, and check whether the picture is the same. I think it would be even neater if you bring in both the small countries and the large countries, and then you do diff in diff around the rebalancing effect. In that case, we would see that the common shock is netted out by the first difference, and we are left with an ability to disentangle the effect of the measurement. I don't think it's going to make much of a difference here, because from here on you are at the cap and you have only one treatment. But over here, more likely than not, there is a convolution. And if you look at the sample period, this is the dollar. We know that the dollar is the most important factor in the factor structure of exchange rate. The dollar was on a depreciation trend post-global financial cycle, except for a couple of blips. But I think all these countries that get pushed against the cap are essentially reflecting the currency wars at the time of Manteiga, when he was screaming that Brazil was driven, the currency was being driven by the QE in the US. But I think the good news here that this can be corrected very, very easily. So what do I mean by some redundant statement? What are the main point of, again, I read the paper backward, and the presentation, I think, reflects a more polished section 4 and 5 of the paper. What are the main points? It's interesting, right? Models with UIP are non-starter. Models with exogenous UIP cannot fit these facts. Those are fair statements. And the evidence aligns very well with the inelastic market hypothesis, endogenous UIP, and etc. But this is discussion stuff that could be, that I don't think requires that amount of effort. And also that FXI in this setting is effective without other form of segmentation. See, typically when we write model in which FXI is effective, we put in some suns in the wheel of the model, and then we generate imperfect asset substitutability, and we have effectiveness. Here, that is driven by exchange rate volatility. However, the asset pricing framework that is very useful to guide the specification of the second part of an empirical result to which I come in a second, it's really not suitable to quantitatively evaluate macro model. We can make statements about macro model in the context of a partial equilibrium framework like that. In particular, I'm really not sure what we learn about the discussion of the trilemma, but this is a minor point. So why are floaters more effective than peggers at stabilizing? I mean, the basic point is over here. The risk-bearing capacity is captured, is endogenous. This type of model. This is the kind of idea that is in Oleg and Dimitri framework. Over there, the volatility is endogenous, and therefore, that is critical, it's beautiful, it's very elegant, but it has the limitation that we cannot really apply that framework to an environment where that has been squashed with this or some other approach. So, so low volatility comes about with intervention, with what else is going to come about. So in that sense, it's hard. Obviously, if there is less market segmentation and I apply this elasticity, it will tell me that I need much more intervention to achieve the same change in the exchange rate once volatility is down. Last part, my third set of questions goes back to the positive. I think there is a very interesting set of results on the estimation of these foreign exchange rate rules. So F is the government, essentially is another type of noise trader. And the paper check whether the countries actually respond systematically to the noise trading emerging from the market. And the answer seems to be no. However, that table in the paper, it's a bit, so really the coefficients are not statistically significant. They are a little bit all over the places, are square, some are small, some are low. I think there is scope for doing more. And I think this is the really interesting piece of evidence relative to the macro model to which you seem to be wanting to talk about. And this kind of evidence raises a couple of important questions, I think. So why is it the central bank don't stabilize exchange rate as that class of model implies, and as you show us that in principle they could? Why is it not happening? And in this situation, Andre, Martin, and I, talking about capital control, have a similar paper, right? We look at optimal capital control policy, why countries don't do what this model suggests. Is it theory out of practice? Is there something in this theory that policymakers don't know? Or is the other way around, that is usually more likely than not? So what are these models missing to prescribe something that doesn't take place? And this is easy to guess. It would be very difficult to implement something like this. But what else can we learn from these shocks and these estimates? Well, what I think the paper can give to central banks is an idea how much you have to intervene if you're a floater per unit of change in exchange rate that you want to engineer. Great paper. I really like it. And thank you.
Thank you, Alessandro. So we have time for maybe half a question, if somebody's up for the audience? If not, Chang, you can use the time to reply.
Maybe I can try to address Alexandra's questions, and then maybe we can take a couple if we have time. Okay, I think we're out of time, basically, right? Okay, I'll just be really quickly, just 1 minute. Yeah, so thank you for the great discussion. I think about the first one, I think we talked during the break. So actually, you're saying that I should check about the common shocks, global financial cycles, and also the big countries. In fact, I think I did that. I mentioned in one of the footnotes, and also I did definitely check the dummies with global financial cycles, and they just don't show up significantly. And also, I've seen a time fixed effect kind of take, can control for that. So yeah, this is something that I probably should emphasize a bit more in the paper, but thanks for mentioning that. Second one, I do agree that the point you mentioned that in the model framework, at least in Hockey-Mooking and Quebec's majority, how the model is framed is that you have this volatility and market segmentation that kind of intertwine with each other, right? So if you shut down volatility, you shut down segmentation simultaneously. And I don't think there's a good way, at least through the lens of this model, to separate these two things. And perhaps, I need to think about that more if we can do something about that. And the last comment, which I think is really interesting, this is something I would like to work on in the future, which is why don't central bank internalize those shocks from the index rebalancing? Why don't do anything about it? There's something, this story is interesting, but whether they don't do it, why not? I think that's maybe not in this paper, but perhaps in the future work, I'm happy to explore. Thank you very much. I think we're out of time, right? Yeah.
Yeah, thank you. Great. So, great. Now we have Yuan from Johns Hopkins University.
Okay, so I'll stand here. It's a great pleasure to present here. Thank you for having our paper on the program. So this paper is called Intermediate Elasticity and Limited Risk-Bearing Capacities. So my name is Yuan. I'm from Johns Hopkins, and this is a joint work with Amy Huber from Wharton. So basically, the motivation of the paper is that there's a growing literature has offered at least evidence that financial intermediaries, right, they matters for asset prices. Now, in particular, right, these intermediaries, they have limited risk-bearing capacities, right? They don't have infinite bearing capacity, meaning that you have an upward sloping supply curve. Now, therefore, if you have some customers who have these purely uninformed trading demand shocks, they could impact asset prices. And of course, right, the magnitude is going to depend on intermediaries' risk-bearing capacities. Now, the questions that we're going to ask in this paper is, can we use the trading data to actually quantify intermediaries' risk-bearing capacities and this effect on asset prices? Now, specifically, let's start right with the concept of elasticities in asset pricing. Right, we start with the very canonical asset pricing, which states right this risk premium that we have is a product of quantity of risk and price of risk. Right, and so if you think about it, right, if you really have these trading demand shocks, they affect asset prices. They should basically they should do so by altering the amount of non-diversifiable risk that these intermediaries bears. So what we do in this paper, right, the things that we estimate, as the paper's title suggests, is called intermediate elasticity, which is the price response to a marginal unit of risk that's induced by trading. Now you can see here this lambda, dP over P, which is the percentage price change. This is the familiar term. What's new is in the denominator, which is the quantity of risk induced by trading. Now, this is the inverse elasticity because we put the price on numerator, and semi-elasticity in the sense that in the denominator, what we have is just a quantity of risk, not the percentage change in quantity. And you can see here, if you have a higher lambda, it's going to mean a higher price impact from trading, and this means a lower risk-bearing capacity from the intermediary's perspective. Now, this is different from the typical way that people talk about IO elasticities, which is dP over P or dQ over Q. And you can see our lambda is defined with respect to risk. And clearly, right, the quantity of risk is different from the quantity of securities. And why do we want to do that? Let's consider a very simple example, right? let's consider an intermediaries, right? You have two customers, and two customers are submitting buy orders for two assets, okay? And if you think about this, if these two assets are perfectly negatively correlated, okay, then basically the intermediary can really offset the risk. And effectively, the intermediary takes no risk. So on the other hand, right, if they were not perfectly correlated, then the intermediaries are exposed to non-diversifiable risk. And this requires compensation. Now, really, this idea comes down to this very basic point that these securities, they might be fungible, right? Risks are not, right? This will, as you will see, generates a simpler cross-substitution. And this idea that risk and quantity and asset prices are related, this goes back very long, right? I mean, empirically, we have found many evidence showing that trading indeed impact asset prices, not just because of information. And the theory models has pretty frequently attributed these effects to the effect of risk. There are papers like Duffy's paper, Vallanos Villa's paper, but he can go back as early as 1980s, like Grossman Miller's paper. Now, there's also abundant empirical works that documenting reduced form evidence that risk indeed matters for this price-quantity relationship. What we do in this paper is three things. First of all, we identify the most important traded risk factor in the FX using novel trading data. And in particular, as we highlight in right, this will be different from the unconditional risk factors that price unconditional expected return. We're going to detail what's that. And second, we're going to quantify the risk-bearing capacity through this intermediary elasticity by instrumenting for trading demand shocks to these traded risk factors. And three, we're going to combine the exposures to these factors and to estimate the risk-bearing capacity and then derive the cross-elasticity between different currencies and between different asset classes. Now, for the roadmap, we're going to start with a conceptual framework. We're going to tell you how to define a factor-level trading demand shock for any given factors. And then we're going to show you a way of doing a modified PCA procedure to actually identify the most traded risk factors. And three, we're going to derive these intermediate elasticities for these factors. Preview of the empirical results. First, in terms of the traded risk factors, we find that you only need three factors to jointly explain 90% of risk that intermediaries bears when they are accommodating our customer flows. And these are familiar factors, but we're going to offer new results on the trading flows into these factors. And second, we're going to estimate the intermediate elasticity of these factors, and we're going to find the risk price by 5 to 30 basis points across different factors in response to $1 billion of trading demand shocks. And these are estimated using the sovereign bond auctions, the announcement of that, as instruments. And three, we're going to use these three factors estimated elasticity, and we're going to map that to the cross-asset elasticity. And this is going to quantify, give us a whole panel between 16 currencies and also seven asset classes. This is the first in the literature. So let me start with the model. It's a very simple model. It's a two-period model within foreign currencies, right? And we take the US dollar as the numerator, or the home currency. So we're going to unit mass of intermediaries, right, who is taking these customer FX trades. At time one, right, the currency's fundamental return realized, which is basically the currency's return in absence of any trading demand shocks. And at time zero, there's a trading demand shocks, and basically which gonna move, right, the price at time zero. And so the total equilibrium return is gonna be affected, of course, by these trading demand shocks. And what we're interested in is basically how the asset prices move at time zero, which is delta P, right, going to be affected by the risk that intermediaries takes, right? And the sensitivity that we're going to get is the intermediate elasticity lambda. Now, of course, to estimate this, we're going to first quantify the trading demand shocks, and which going to in turn, right, ask us to identify these traded risk factors. So we're going to start with doing that. Now, how do we think about factors? Basically, it's a portfolio, right? So let's just define, right, the traded risk factor by the factor of portfolio weights, which for the first factor is B1. So here the B11 just says how much weight you put in the first currency, second currency, up until the last currency, right? And then right, because we observe right, in the data we can have the trading. Then let's denote right the currency level net trading demand as F, which is basically Fn here is just the net customer buying demand against the US dollar. And if you think about it, right, if a customer buys right Fn dollars from an intermediary, and we know that the currency is low down a factor, basically by the beta amount. So really, if dealers are taking that shock, it's effective as dealers are taking Fn times beta amount of factor flow plus some risk that's orthogonal to the factors. Now, of course, you've got N currencies, right? The intermediaries can basically offset some of the risk across different currencies. And so what's really happening after dealer taking in all these shocks, the total amount that dealer takes is really just the summation of F times beta. And then basically you can write in the matrix notation there. And our objective, as we said, is to identify the most traded risk factors that coming from this net trading demand F. So really what we do is very simple, right? We just try to maximize the variance of Q. Q is measured in dollars, but we want to translate into risk terms, so we actually multiply by the variance of the factor return, and so we maximize the variance. Here we do a normalization to also normalize by the variance of factor itself, so that actually you can freely scale the factor. You can double it, you can reverse sign of it, do whatever you like. The objective function is going to stay the same. And basically that's the first factor. And the second factor is pretty much the same, conditional on it being uncorrelated with the first factor. And you can see this looks like a PCA, and in fact you can solve that by adding 3 lines of code to the standard PCA, but really what's happening here is that what we are doing is finding the traded risk factor, whereas the standard PCA you do just simply maximize the variance of unconditional expected returns. And then once we got those factors, then we basically try to determine those factors' elasticity. And here we're going to make a very simple model. We're going to say, okay, we're going to assume the unit mass of intermediary, they have Kara preference with a factor-specific risk aversion. This across factor variation risk aversion, you can think about maybe being like some intermediaries, they are just unwilling to take certain type of risk, they have some certain limits. So we're going to let the data to speak on that. And the intermediate optimizer holding, right, for each factor. And of course, right, by market clearing, right, if investors are selling the amount, intermediary have to take the amount, and because they're doing the mean variance optimization, that means the asset price has to adjust in equilibrium to induce them to exactly sell the amount. So we're going to skip the optimization problem, but by the end of the day, this is very simple, like the thing you probably did many times in your PhD, basically is the price impact going to equal to the lambda times the quantity times the variance, or times the variance of the factor. Or this lambda is pretty much the risk aversion, or the per capita risk aversion of the intermediaries. Or equivalently, the intermediary elasticity that we're going to estimate here is really the price impacts divided by the quantity of trading induced risk. A few nice properties. One, we can freely scale the factors, and in fact, you're going to get the same lambda regardless. So lambda is invariant to the factor scaling, and it's very intuitive because that's relating to risk aversion, and risk aversion should not be changed by scaling. And second, it's uncorrelated across factors, which means that we can do this factor by factor without worrying about cross-factor interactions. And later on, once I show you the empirical results, I'm going to show you how to map this to the panel of cross-elasticities between assets. And before proceeding to data, we just want to say, okay, why we focus on the FX data? You can see the framework here has nothing special with FX, but FX we think is a particular good application of the theory because one, right, is a very intermediate market with dealers being sophisticated agents, and they're actually optimizing, right? They're actually optimizing the order portfolio rather than doing one currency by one currency. And even if one dealer is focusing on one currency, we still have a very liquid inter-dealer market that allow dealers to off-share risk between each other. And intermediaries, of course, they are important to understand their marginal pricer, and they enforces cross-market arbitrage opportunities. And the last thing is, of course, the availability of data. So specific, the data we use is from the CLS group, which cover more than 50% of the global FX trading volume, right, between roughly for the last 10 years. And they have the daily FX trading flow data. Now, this includes 16 foreign currencies, mostly the developed country currencies, plus the US dollar. And it's broken down by customer types. You have funds, corporations, and non-bank financials, and outflows are like intermediated by banks. And here by banks, it really means dealers and also hedge funds, because when hedge funds trace through the prime brokers of the dealers, they will actually show up as a bank in this data. And we're going to reconstitute all the flows relative to US dollar. That means if a customer buys euro and sells Japanese yen to a dealer, we're going to record it as a positive euro flow and a negative Japanese yen flow. Now here we prove in the paper that there's nothing special about US dollar. You can you can change the numeraire currency, whatever you like, and you're going to get the same results regardless. And we want the total FX exposure. That means we're not only using the FX spots, which is usually, if you look at typical other papers that are using the CLS data, they only focus on spot. But here we're also discounting the FX forward and also the FX swaps. And we got the daily return from Bloomberg. That's standard data. And then we aggregate everything to weekly level for analysis. The first result we have here is what are those factors? These are the traded risk factors we identified from the data. So before looking at this factor, let's first look at the bottom, right, which is about the variance of risk explained. As you can see, the first factor is about 65%. The last two factors explain about 10%. In total, that's about 90% of risk being explained. If you look at the factors, here we highlight the US dollar and also 6 other major currencies that people trade. You can see basically the first factor is a dollar factor, right? Long dollar, short literally everything else. The second factor, you can see it longs, right, the Aussie dollar, Canadian dollar, and also the British pounds, and short the Swiss franc, euro, and Japanese yen. So this pretty much looks like a carry to us. The third factor, you see a pretty large weight of euro against Japanese yen. There's also, of course, some weights on Canadian dollar and USD, and we're going to later show you this is really because we want to make sure those factors are orthogonalized. So now we sort of have an idea about what those factors are. So let's, instead of using the PCA in sample way, let's just construct that factor ourselves and see how close we get. So basically, the first factor, dollar factor we get is just $1 in each dollar, and then 1/6 in the 6 major currencies. And the second factor we create, the carry factor, is just 1/3. It's just 1/3 on the long. It's just 1/3 each, right, on the high interest rate versus low interest rate currencies. And then the euro yen factor is simply long euro and short yen. Of course, right, if you construct the 3 factors this way, they're not going to be uncorrelated with each other. So we're going to run our procedure on these factors to make sure they're orthogonalized. And on the bottom is to show that the orthogonalized economic factor, which we're going to use throughout later on in the paper, versus the PC factor we just constructed. And you can see their correlation is pretty high. The first factor, these correlations are all over 90%, and the first 2 factors, the correlation in return and flow is pretty much close to 1. So we're going to use it. Basically, we're going to use these econ factors throughout because they are more stable. And these are the customer trading flows to these traded risk factors. And here, right, we're plotting the cumulative customer flow. So the flow that the dealer takes is actually the other side. It's actually inverse of that by market clearing. And you can see, basically, for the past 10 years, customer has really been buying about $1 trillion of dollar, and that's particularly after the 2020 COVID crisis. And then on the other hand, the customer has been selling, right, the carries, which of course these are all like what the dealer have been taking on the other side. These are the return of the factors, and I'm going to skip this 4 times. You know this. So now we're gonna look at the instruments for elasticities, right? And basically now we clearly, right, if you just run a regression of price on quantity, that's illegal, and you have to get an instrument. And specifically here, the instrument that what we use is the announcement of the offering amount at the upcoming sovereign auctions. And the relevance is really coming from the foreigners, right, do participate in this auction. And because these bonds are issued in local currencies, the foreigner needs to exchange for local currencies in order to participate. And the exclusion restriction is coming from this offering amount are typically forward guided, and they contain limited information on demand. And in particular, here we're using the announcement of the offering amount, not the actual amount, which might reflect demands. And we use a weekly sample. We exclude the COVID period because that's a period where you see much more fluctuation in both the market volatility and also in the bond markets. So here's our result. Basically, for the instrument we use, for the dollar factor, we use the U.S. Treasury auction. And for the carry factor, we basically use the Aussie, Canadian, British, plus Japanese auction. And that's all in the same week. And then for the euro-yen factor, we basically use the euro area bond. And here we use week T-1. And T is just because for the euro area, it does not allow for direct bidding. So it actually needs one. So it does not allow like these foreigners to directly bid in the market. So they have to go through the dealer, which takes more time. And let's look at the estimates. Basically here, everything are statistically significant. Next page, we're gonna interpret the magnitude of them. And the OLS and IB estimates are pretty close to each other, except for the last factor, which you see is the euro-yen factor, which does see a much higher discrepancies. And if you look at the instrument strengths, then you may worry, well, the second and third instrument look like weak, right? The F-stats is 6 and 4, which are below the usual rule of thumb of 4, which rule of thumb of 10. So we actually did this Anderson-Rubin like confidence interval, which is robust to this weak instrument concerns, and well, at least we can say that those confidence intervals were bounded away from 0, so they are consistent with this interpretation of limited risk-bearing capacity. Of course, you see on the other side is the confidence interval is very wide, 5 minutes or 10, okay, and it's very wide. So that's basically suggesting maybe like those things can be even larger. And now let's interpret the economic magnitude of these elasticities, right? So we have this lambda, which is measuring per unit of risk, and we want to translate that to dollar amount, which is more convenient to interpret. So we just multiply by the return variance of these factors. And what you can see here, basically for $1 billion of trading demand shock, it's going to raise the dollar carry and euro-yen price by 5, 10, and 30 basis points, right? And in other words, right, these intermediaries, right, they raise the factor price by about 1% in response to a 20 and 11 and 3 or 4, like this billion dollar demand shocks to these factors. And this is large compared to equities, by the way. Or the market is even more elastic compared to equities. For example, right, the Garbaz coalition paper, right, they find, right, you really need 0.2% or 63 billion, right, to raise the aggregate stock price by 1%. So the FX market, at least from our estimates, is even more inelastic than the stock market. Let me say why, right? I mean, FX market seems like one of the deepest markets in the world, right? That's coming from 2 points, right? I mean, one is that this clearly we're estimating this factor level undiversifiable risk. So this is what have to be borne by the dealer. And second, probably more importantly, is that if you think about FX market, then really everything has to go through these intermediaries, which has very limited balance sheet capacities. So is potentially coming from these more limited arbitrage capitals of these large FX dealers, which we know probably there are just a couple global banks in the data. So now we're going to proceed to the third part. We're going to think about those factors. We're going to think about connection of those factors with individual assets. Now, remember we construct the factor to explain trading-induced risk. There's basically no guarantee that these things have to explain unconditional returns. But as you can see, the dollar and carry factor are also the unconditional risk factors being shown in the data. So what you can see here is we project each currency's return onto the 3 factors. And we see they also explain a large part of unconditional returns, about 70 to 90%. And basically the idea here is very simple, right? If you think about this trading demand shock, they're going to impact the price of factors. then they will naturally also impact the price of currencies that load down these factors. Now, specifically, this is a formula that we derive in the paper, which is to say, okay, we want to calculate this cross elasticity. What happens to the currency M's price if, right, you shock the currency N's price, if you shock the demand of currency M, holding all other demand equal. So this is pure partial derivatives. And the paper really comes down to this simple formula that channels through the factors. Now, specifically, right, a demand shock to currency M going to expose the dealer to more, right, like this undiversifiable risk at the factor level, at the factor K. The first term is actually given by the beta, as I explained in the beginning. And then at this factor level, this demand is going to impact the price. And this is coming from our intermediate elasticities. And finally, right, at the last term, as the factor price changes, the currency N's price changes to preserve the law of fund price or no arbitrage in the cross-section, which is also given by the beta. So you see, this is actually very simple. Once you estimate the intermediate elasticity, which we have, all you need to do to compute this is just to compute betas, the standard asset pricing task. And this actually circumvents a lot of challenge when you try to estimate cross elasticity for a whole panel of currencies. Think about it. If you don't have a model, what would you do? Well, you would run a reduced form regression, but then the demand shock, not only you need to have instrument for all those demand shocks for all currencies, but also they likely be correlated. You suffer multicollinearity. So basically, you have to put on structures. And the key feature of what we're going to get here is two things. One, this type of cross elasticity easily give you complementarity. As you can see, if two assets are on the opposite leg of a trade, that they have negative beta with exposure relative to each other, then you can see you get a negative cross elasticity. And second, it's also symmetric. That is, the shock of M on N is the same as N on M. You can see, basically because we have two beta here, if you switch the M and N, you're going to get the same thing. So now we're going to show you the table, right, which is the price impact coming from 1 billion demand shock, big trading demand shock in the row assets on the column assets. And here we only report you half because this matrix is symmetric, so the other half is there. And you can see, first of all numbers are positive. This is because everything loads on the dollar factor in the same direction. And second, if you look across the long carry leg and short carry leg, you look at these red numbers. They're smaller compared to the remainder ones. It's because, right, exactly as we said, they're on the opposite leg of the carry trade. They complement or they hedge each other in terms of the risk exposure to the carry factor. And three, but if you also see a very low elasticity between the euro and the yen, it's because of they're on the opposite leg of euro-yen factor. And finally, when we do as a sanity check, we can look at the last column, the Hong Kong dollar, right? We know the Hong Kong dollar is pegged to US dollar. We didn't use this peg information in our estimation, but if you look at this, right, we basically get zero. And supposedly you should get zero, right? Because a peg currency, like literally, by definition, it should not be affected, right, by the trading demand shock of any other things. And now if you look at our formula, there's really nothing special about currency per se. You can actually substitute the currencies with assets. And you can apply this formula to non-FX assets, which is what we're going to do. And so we're going to look at 6 major asset classes: CDS, commodity, corporate bonds, equity options, and US treasuries, right? And first of all, we're going to look at how does trading demand shocks. And here we're going to look at like basically the assets loadings, right, on these FX factors. And you can see here you get much smaller explained, right? It's about like 20 to 30% for these asset classes. So, these markets are not fully integrated. But what's really, but one thing I want to point out here is if you look at the exposure, if you look at the beta to the carry factor, then basically everything else is a positive. The only negative is US treasuries. And you will see it will show up later on in our elasticity estimates. And so when we apply our estimates to compute the cross elasticity, what we really compute, the formula, is a cross elasticity channels through the 3 traded risk factors. We miss a large part. But of course, right, once you have better data, you can fill in the rest. And this is the asset elasticity due to the traded risk factors. And here, for time's sake, I'm just quickly going to point to that these three factors, you see, right? This is basically the impact of trading demand shock into dollar, carry, and euro yen on the asset classes. I just want you to know that they have different magnitudes, different size. And really the point we're making here is probably not a good idea to just talk about how does trading demand shock in the FX markets shocks the other asset classes. And you can see all shocks are now created equal. It really depends on what risk shock that is actually getting shocked. And this is the cross elasticities between these major asset classes, right? That's being channeled through the U.S., channeled through our traded FX factors. And the only thing I want to point out here is look at the last column, U.S. Treasury. And you can see the U.S. Treasuries uniquely have negative cross elasticities with most other asset classes, and that is basically reflecting in some sense reminiscence of the U.S. Treasury's safe haven status. And Yarrow framework shows up because that's the only thing that hedges the carry factor exposure relative to other assets. So let me conclude here, right? So what we do in this paper is very simple, right? We just try to extend this idea of non-diversifiable risk, which comes from this Marcus Ross, right, to these representative intermediaries, right? And then we identify three traded risk factors that explain 90% of risk that intermediary take during trading. And then we link these trading quantities to asset prices through risk, right? And we find, right, that these intermediaries raise the price by 5 to 30 basis points in response to $1 trading demand shock. And then, right, we use this common factor exposure to these traded risk factors to establish cross asset and cross currency, right, cross currency elasticities. And being able to identify this in a whole panel of assets is a first in the literature. So overall, the takeaway from our paper is really we'll think about right, the intermediate elasticities, right? We want you to think, we hope like we convince you that at least for the FX markets, an integrated or portfolio view rather than asset by asset is useful. Thank you.
Thank you. So we have David Etomio discussing. Thank you.
Oy, oy, oy. Acá. Acá. Sacan conclusions? Here. Fantastic. Well, there you go. All right, thank you so much for asking me to discuss this paper. Thank you so much for welcoming this Hollow Holes. It's really a pleasure. And thank you for asking me to discuss Yu's paper. I always love what you write, so it was a pleasure to spend a couple of days thinking about this paper and coming up with a few questions of what else would I like to learn from the authors. All right? So what I'm going to do today is I'm going to tell you a little bit about the paper, summarize it quickly. You did a great job. I'm going to do it anyway because that's my job. And then I'm going to tell you a little bit about, again, what else I would like to learn from this paper. So the authors set out to do the following. This paper's goal is to estimate intermediary elasticity. The idea is the price response, calculating the price response to 1 unit of traded FX risk. Now you'll notice that the authors don't set out to calculate the elasticity of one single currency, but rather they think in terms of factors. Why? Well, it makes sense because currencies tend to commove, right? And if I'm a dealer and I have two customers coming to me with two different trades, well, maybe those trades are going to offset because they're in the same currency, but maybe they're not in the same currency. However, they're going to offset because the risk inherent in these two currencies offset each other. All right. So what the authors want to do, they really want to set out to calculate the amount of undiversifiable traded FX risk that is borne by intermediaries by virtue of their willingness to make trades, to trade with customers on the FX market. Once they have calculated this amount, they actually calculate, okay, for 1 extra unit of risk that this intermediaries are willing to take on, for one factor of FX? How much are they going to change the price that they quote on this specific factors? Okay, that's really the elasticity, the lambda there at the last but one row in the formulas to the right hand side. All right, so the authors set out and do that empirically, and what they find is they find three factors mostly. The first factor looks, it's here to the left. It looks a hell of a lot like a regular dollar factor. Long dollar, sure, everything else. And remember, these are factors coming from both the returns and the trading, right? They're not your usual PCA that you take from returns. The second one is a factor that looks a lot like carry. It is long, high interest rates currencies and short, low interest rate currencies, just like the usual carry factor. And the third one is kind of like a very specific to the setting, euro-yen factor, okay? And I was curious, how do this carry factor, let's focus on the carry factor for a second, how does it look compared to what we know already from the literature? Again, this PCA only based on returns, and they look very similar, which is very reassuring. So here I put on the x-axis the traded factor carry weights from the authors. On the y-axis, Verdelines 2016 papers beta of these currencies, the beta of these currencies to the carry factor. You see they align 1-to-1, which is very reassuring. That's really what we want to capture. All right. So once they have this quantification of the factors, they can actually calculate how much dollar value FX trade, undiversifiable FX trade, these intermediaries have on their balance sheet, okay? And this is what they do here, accumulate the total, the sort of accumulated net amount that they're holding, intermediaries are holding, is this sort of dotted red line that you see, okay? Once they have calculated this total amount of risk held by intermediaries, they can calculate the elasticity, right? The lambda that we started with. So they calculate it, and you see it here. Essentially, we're regressing returns of FX factors on the traded flows, right? And of course, we need to instrument it because, as you said, it's illegal to do price on quantities. And so they instrument it, as you mentioned, using these the announced issuance amount of sovereign bond auctions, okay? Once they have that, they do a bunch of more quantifications, looking, for example, at the cross elasticities across currencies and assets. All right, that's what the paper does. Now, I think that the modeling part of this paper is fantastic. It's really compelling. It is elegant, intuitive, and I'm a big fan of it. So what I'm going to focus on is the empirical part, and I would like to see. Here's what else I would like to learn from the empirical estimations. All right, which is really where the authors take these quantities from the model and map them into quantities derived from actual data. So the three questions I have are really, who are these representative banks that we're talking about? What is special about them? I would like to get a little better understanding there. Second question is, what is the exact mechanism in this instrumental variable regression that links primary auction and FX flows? And thirdly, I would love some more context for kind of the boundaries of these quantification exercises. All right? So the first question I have here is, okay, we're dead set on estimating this intermediaries' elasticity. But who are these intermediaries? Are they just bank? Are they dealers? Let me explain what I mean. So there's a couple of papers that work on a very kind of similar kind of framework. One that I want to point your attention to is the Lualish, Pecora, Sumogi, and Ward paper that I happened to discuss last week. So this authors also use the CLS data as the one in the paper from today, and they make a valiant effort to disentangle the trades that happen between, okay, FX dealers and their clients. Who are the clients? Well, they're up there. To the right, you have a screenshot from this data set from the Lualish et al. Paper. All right, so the clients are, sorry, it's a little tiny, but they're corporate, funds, and non-bank financials, okay? But it's not just them. A fundamental client for the dealer banks are the non-dealer banks, right? Those banks who are just essentially customers. And so they do. The author is in this Lualish et al. Paper has this effort in disentangling them. The author in the paper today, however, when they want to really quantify the amount of risk borne by these intermediaries, they focus on three customers: corporate, funds, and non-bank financial. Essentially bundling together all the financial sector or the bank sector as if all of the bank sector was the intermediaries for the FX market. However, you'll notice that that's not necessarily true. There's some little bank who's just a customer. They're not the dealer, right? And so what I would really like, if you want to push this idea, and I do, and you're doing a great job of this intermediary risk provision, risk-bearing capacity, then capture these intermediaries, get to the dealers, right? So you can essentially take out the non-dealer banks and you focus on really the risk borne only by the dealers, right? Those are the guys that are doing the pricing. So that's the first sort of suggestion I have. Does this sort of suggestion make sense? Is it going to make a lot of difference? From the same paper, here there's, see, I'm reusing my own slides from the previous discussion. It's very, very eco-conscious. So you see the shares of FX trading from the different kind of clients. And you see the non-dealer banks, they trade 85% of the volume. That's a lot. A lot of it is going to offset, right? Kind of like here, you don't see, but a lot of it is going to offset. So I'm not sure how much is going to influence the actual point estimate, but since part of the objective here is to estimate the right elasticity, then get rid of it and then get to the dealers. Second thing I would like to know about is, okay, so this is a little bit out there, but if you're trying to tell me something about what this elasticity of the dealers, tell me about what is driving these elasticities. These are the dealers in the FX market. Now you'll notice, because I put little flags on them, most of these dealers are American, right? Great. But some are not, right? There is one Swiss one, two British one German one. I would suspect that the elasticity that a dealer is willing to provide in a currency is going to be a function of whether that is the currency that that dealer specifically is using to book their profits at the end of the day. Yeah, more like 5 minutes. And so I would like to understand, take this composition and can you tell me something? If, for example, the Deutsche Bank were to drop out of the FX market, how would that change the total elasticity of the dealer market for FX? Because what is the remainder is a set of dealers more skewed towards the United States. All right, so summarizing, how does the representative bank look like? That's my question. Second, okay, so we get to the estimation, and what we want to do, right, is we regress some sort of like scaled return on the order flow, illegal, so we instrument the order flow by using this announcement of sovereign bond auction quantities, all right? So what I would love to learn more from the author is really, what is the economic mechanism behind this instrumental variable strategy? So here's two ways that you could think about it. So the first way, let's focus on the carry factor for a second, is that there are US FX dealers, right, who are participating to the auctions of, say, Germany. They buy the German bonds, and then they need to source this euro somewhere, and then they trade them, they take them from their clients, right? So in this case, they're buying, the intermediaries are buying these treasuries, and they're getting euros. But it could also be the FX dealers, again, US FX dealers, they're not participating, right? They're outside, and their clients are the one that are buying in the auction. So actually now the FX dealer need to sell euros to their clients. Which one is it? It would be very easy to just show me the first stage regression, and they would tell me really which of the story it is. And I have a suspicion. So what I did, that is the first one. So what I did is I pulled the ranking of the specialists from the Italian government bond markets that you see here to the right, and look at this number. They look sort of familiar, the names, they look familiar. You have Deutsche Bank, Citibank, Barclays, JP Morgan. A little further down there is Goldman Sachs, the usual suspect. Who are the FX dealers? Oh, look at that. JP Morgan, Deutsche Bank, Citi, Goldman Sachs, they're the same people, right? So you can really start telling me something about what is going on in the back. Is Germany very different? Not so much. These are the ranking of the specialists for Germany, very tiny. But you get Citigroup, Morgan, JP Morgan, Goldman Sachs, and so on and so forth, right? So I would love to really understand what is the mechanism that you have in mind in this instrumental variable regression. The last minute, I promise, the last part is about the really qualifying, if you will, the quantification. So I come from a microstructure background. I would imagine it's intermediary dealers. They're sort of like dealers. They want to end the day with a zero inventory. Do these intermediaries in this paper look like my market makers? Not really. Since the beginning of the sample, this intermediaries, I want to call them banks in general, they have accumulated 1.7 trillion of undiversifiable FX risk. That's a lot of money. That doesn't look like I would imagine the dealer. So there's something here in this distinguishing between the dealer and intermediaries that I think needs to be thought through. Last part. Another part of the quantification is the authors say that around 40% of total returns for the dollar factor is explained by trading flows into the factor. 40% of the FX return of the dollar are explained by order flows. It seems like a lot. So I would love to, can we get some sort of comparable quantity for, say, the equity of sovereign bond market, kind of ballpark it? Like, is it normal this 40% or is this a lot? And so I would love to kind of really provide some context for these quantification exercises. These questions are for the authors, so what I'm left with is saying this is a brilliant, thought-provoking, skillful executed paper that I truly enjoyed reading. I would love to learn more about whether banks and dealers are the agents that matter, the economic mechanism behind instrumental value estimation, and how to interpret the quantification exercises. All right? Thank you so much, and I'm excited to see the next version.
Okay, thank you, Davide. We might have time for one question.
Okay.
One question.
Or let me.
Okay, yeah.
Let me first quickly respond to these questions. Thank you so much for the discussion. So, I think a lot of loose ends, like in terms of empirical implementation, in terms of the IV, and also in terms of the CLS data that we need to clean up. And thank you for that suggestion. And one thing I wanna point out is for the last part is we mentioned here, right? We mentioned the amount of non-diversifiable risk taken by dealers. Remember, we're only looking at the CLS data. We're only seeing the risk they're taking in. Presumably, the dealers are able to offload some of the risk through their affiliated banks, selling to depositors or something that, unfortunately, we won't be able to observe that in the data. So clearly, right, here what we have seems an overestimation because the dealers may have get rid of that risk through some other channels, but which we don't see. So that's the one clarification we want to make. Any other questions? Okay. Okay, thank you.
Okay, thank you so much. So now we're going to have the last presentation of the afternoon. It's going to be Sharon Ross from the Federal Reserve Board. And then we will have Valentina Bruno discussing the presentation.
Okay, well, thank you so much to the conference organizers for selecting our paper to be included at the conference. My name is Sharon Ross, and I'm very excited to be presenting today my paper called Quantities and Covered Interest Parity. This paper is joint work with Toby Moskowitz, Chase Ross, and Kaushik Vasudevan. So this paper is going to be about the expected returns on bank intermediated arbitrages. These bank intermediated arbitrages are commonly called bases, and they've exploded since the global financial crisis. One of the main reasons that's been well documented in the literature of why these bases have exploded since the financial crisis is because arbitrage is costly for intermediaries, and intermediaries face a number of regulatory constraints. So most of the work on these bank intermediate arbitrages has focused on prices, but there's not as much evidence on intermediaries' positions, which is what we're going to look at directly in this paper, the role of quantities in coverage interest parity trades. So we're going to try and answer an unresolved puzzle, which is that there's substantial heterogeneity in the sign and magnitude of bases within an asset class. Specifically, we're going to use supervisory and regulatory data on quantities to study covered interest parity bases and the implications for intermediary asset pricing. We're going to try and explain these covered interest parity violations, which is, of course, a very important market for global dollar funding. So as a quick refresher, covered interest parity says that investors should be indifferent between two things. The first is holding dollars and earning the dollar risk-free rate. And the second is taking those dollars, exchanging them for foreign currency at the spot rate, investing in the foreign risk-free rate, and converting the foreign currency back to dollars by buying a forward. So if you look at the basis as the difference between these two options that an investor has, the CIP condition is that the basis should be equal to 0. Now, it's been well documented in the literature that the basis is not equal to 0, and that's what I was describing as exploding since the financial crisis. In fact, the basis is empirically about negative 30 basis points in our data. And the fact that the basis is negative means that synthetic dollar funding is expensive. Other ways to think of this is that there's a shortage of dollars or there's a lot of demand for dollars in the market. So in addition to this basis being negative on average, there's quite a bit of variation. So on this slide, I've plotted the 1-week bases against a number of currencies, 6 currencies against the US dollar. And on the right-hand side is the one-year basis. And you can see there's a lot of variation. You can see if we look at the right-hand side graph in the one-year basis, there are notable spikes around the global financial crisis and early on in COVID. So one question is, why have these bases really varied a lot from zero? Why are they not on top of the black line, which is at zero? But another question is, why is there so much variation in the cross-section? So at any given point in time, why are the colorful lines not all on top of each other? And that's what we're trying to answer in this paper. What explains the cross-section of the covered interest parity violations? So here are some summary statistics on the one-year covered interest parity violations. You can see on average it's negative, and it varies across the different currencies. It's positive against the Australian dollar, for example, likely because there are a number of commodity-related. It has a lot of commodities which are invoiced in dollars. But if we focus on the last two columns, you can see that the basis is negative, about negative 15 basis points against the British pound, and about negative 50 basis points against the Japanese yen. And so it's puzzling that they're not equivalent, because what that means is that someone can earn 15 basis points to lend dollars in the UK versus 50 basis points in Japan. You would think that you would want to lend your dollars where you can earn the most. So this is the puzzle that we're trying to answer and address in this paper. So we have three main findings. We have a toy model in the paper. I won't discuss that too much today, other than to mention that they guide these results that we have. So first, we show that unlike what textbook says about an arbitrage, banks don't hedge their CIP trades with maturity-matched safe assets. So in that CIP trade that I described, you have your dollars, you've converted them into yen, and now you need to invest in something that earns the Japanese risk-free rate, like the JGB. But there's only a certain supply of JGBs. It's maybe difficult for a bank to have those. And by not fully covering your CIP trades with maturity-matched safe assets, that makes coverage interest parity arbitrage risky. So this creates a marginal cost for banks in terms of intermediating these markets. We show in the paper that cross-sectional variation in the basis is associated with cross-sectional variation in synthetic dollar demand. And we attribute this to safe asset scarcity. As I mentioned, safe assets are either maybe too hard to find, or the yields are too low for banks to want to hold them. Two other important drivers that we're going to discuss is the role of intermediary segmentation and the role of counterparty segmentation. So in thinking about intermediary segmentation, banks specialize in different markets. We show that how concentrated a market is in terms of the banks that are supplying dollars into that market is an important driver for the basis. We show evidence that banks focus on the markets in which they can best manage risk or have the most expertise in managing risk. And the main point here is that the degree of segmentation and individual banks' constraints are important for prices. So in addition to the overall intermediary aggregate constraint that's been well written about in the literature as determining these CIP violations, individual banks' constraints also matter. And last, the role of demand concentration. You can think of this as banks facing concentrated counterparty risk and that leading to these bases. So all else equal, a bank prefers to lend to many different counterparties. Lending to only one counterparty is risky. So these three results really highlight the role of risk in what is commonly thought of as a riskless arbitrage, and the role of segmentation in driving these bases. So the data that we're going to use is the Fed's 2052A data, commonly thought of as the LCR data. This data covers balance sheet quantities for large US and foreign banks. And the FX sample that we're looking at is between 2016 and 2023. We're looking at 6 currencies against the US dollar. And the data covers about 25 trillion gross notional daily, which is primarily over the counter. And this is quite large and substantial relative to the BIS estimate of the total over the counter FX market at about 110 trillion. And lastly, I'll mention that our data on counterparties is not counterparty specific, but rather groups of counterparties. So you can think of it as like Canadian insurers or Japanese sovereign wealth funds, something like that. The CIP deviations that we're going to use are the OIS-based CIP deviations using Bloomberg data. So here's just some summary statistics on the foreign exchange notional exposure. And what you can see immediately from this graph is that the size of the markets are not all the same. That it varies quite a bit. And with that in mind, we're going to weight a lot of our regressions by the size of the market. So let me get into the results. So we're going to call a market as a tenor by currency. So the euro 1 year, the euro 1 week are 2 different markets. And for each market, we're going to calculate banks' net dollar lending from date T to T plus N for a given currency pair K using the FX swap data. So this net variable, this net amount of dollars lent, is dollars in minus dollars out divided by the sum of the 2 to scale for the size of the market. And if net is positive, what that means is that banks are net lending dollars. And of course, on the other side, to fully hedge their trade, they need to be investing in a foreign safe asset, like JGBs in the example I gave before. To give you an estimate of the magnitude, banks provide about $100 billion on net of dollar funding on the average day. So here I've plotted net for against the euro for the 1 week, 6 month, and 1 year maturities. And what you can see is that they vary quite a bit. On average, maybe it's negative for against the 1 week, so banks are net borrowing dollars. And it seems to be positive on average for the 1 year, so banks are net lending dollars. That tends to be the case across the different maturities. But on average, what you can see is that they're close to 0 on average. And if we go across all maturities and all currencies, that's the case, which means that banks are primarily making markets. They're not taking outsized positions in these markets. So the first result is that bases are decreasing in banks' net dollar lending. So we simply regress the basis for each market on net dollar lending. And we see that the coefficient is negative, which means that synthetic dollar funding is more expensive where banks are lending the most dollars, which is a little bit surprising, right? The markets in which banks are intermediating the most have the largest CIP violations. So we think that this is because banks are facing increasing marginal costs to lend more in the market. So one way to interpret this result is that banks' risk increases with the provision of synthetic dollar funding. And they face these increasing marginal costs, and this leads to the bases continuing to exist. So to dig a little bit deeper here, let's first, the first thing we do is we plot net against the basis. This is just another way of seeing that regression that I described before. And quantitatively, what this means is that if there's a 1 standard deviation increase in net dollar lending, this corresponds to a 4 basis point decline in the basis. And by decline, I mean widening, because we're going to be, the basis is negative. And this is substantial relative to the mean basis being about 25 to 30 basis points. So let me provide a little bit more context of what we think is going on behind this negative relationship. We think that the relationship between net dollar lending and the bases is due to foreign safe asset scarcity. So, as I mentioned in that trade where you have converted your dollars into yen, now you need to invest in something like JGBs, and JGBs are either hard to find or their yields are too low to want to be holding them. So we show and see in the data that banks substitute into maturity mismatched and risky assets in the cash leg. So we're going to calculate something called the safe asset ratio to look at this. The safe asset ratio is empirically the share of high-quality liquid assets, level 1, relative to banks' net dollar lending. And if for each dollar that banks are net lending, if they're perfectly holding safe assets to hedge against that, then the safe asset ratio is going to equal 1. But empirically, we find it's much smaller. If we completely maturity mismatch, then banks hold approximately 5 cents of maturity matched foreign safe assets for each dollar that they're net lending. But if we allow for small maturity mismatches and overlook counterparty risk, mostly by allowing encumbered assets in addition to unencumbered assets, this number jumps to closer to 48 cents. But still, there's about 50 cents of each dollar that banks are net lending that are being held in maturity mismatched foreign safe assets or foreign risky assets. I'm going to show you in the next slide that safe asset ratios have substantial across-market heterogeneity. And we show that cross-sectional differences in the safe asset ratio helps explain the cross-sectional variation in these bases. So here I've plotted the safe asset ratio for the Canadian dollar, the euro, and the Japanese yen across different currencies. And you can see across all of them, it's less than 1. Banks are clearly not using enough safe assets in their basis trades to fully hedge it. And of course, you can see that it tends to increase across longer tenors. So to try and understand a little bit more about why banks aren't holding that many safe assets for each dollar that they're net lending, we have some regressions here. So when safe asset yields are low, the convenience yield on them tends to be high. Is high. So if the safe asset yield is low and the convenience yield is high, then the safe asset ratio tends to be lower. And what that means is that banks decrease their safe asset holdings when the safe asset yields are low. And if we look at the risky asset ratio in columns 4 through 6, you can see that when safe asset yields are low, banks tend to increase their risk. Safe asset yields are low, they decrease their safe asset holdings, increase their risky asset holdings. So the way to interpret, and I should mention that the safe asset ratio and the risky asset ratio don't necessarily have to add up to 1. Only under certain, very strong assumptions would they need to add up to 1 because we're maturity matching. In addition, we have 2 more rows where we're looking at the relationship between the safe asset ratio and the risky asset ratio. And you can see that there's a clear, strong positive relationship between the two. What this suggests is that when banks are decreasing their safe asset holdings, those are also times in which they're decreasing their risky asset holdings of the same maturity. So rather than substituting from JGB with 7 days to a corporate bond with 7 days, the banks might be instead substituting across to different maturities. So if rather than holding a 7-day JGB, maybe they're holding a 5-day JGB, and that involves risk. The second result that we have is that the size of the basis is increasing in intermediary segmentation, or how concentrated a market is in terms of the banks that are supplying dollars. So we define supply segmentation using the supply HHI measure, which is equal to a bank's market share relative to the industry squared and summed over banks. The fact that the basis is increasing in intermediary segmentation could indicate that there's impeded risk sharing that leads the basis to be inelastic, or it might be that there's a role for market power. If we look at the supply HHI in this graph here, I've plotted that on the y-axis. On the x-axis is the size of the market. You can see there's a negative relationship. What this means is, the Japanese yen 1 year and the euro 1 year, those are large markets, and they're not very as concentrated in terms of the intermediaries that are supplying dollars. Whereas if we look at the Swiss franc, the ones in the blue pretty close to where the y-axis is, you can see that those are markets that are smaller but more concentrated. What this means, another way of thinking of this is that a lot of banks are intermediating these large markets, and there are not as many intermediating more esoteric ones. So this result that the basis is increasing in intermediary segmentation is one result that suggests the role of individual banks' constraints. But we'll have some more results that I'll discuss later that add to this. Our third result is that the size of the basis is increasing in demand concentration. So how concentrated the market is in terms of its counterparties. So we're going to measure demand concentration using a similar measure as the supply side, which is the counterparties' market share squared and summed over counterparties. We think of this demand concentration measure as compensation for counterparty risk. Plotting the demand HHI against the size, there's not that much of a clear relationship between the two. And if you look at the y-axis, there's quite a bit of variation. I'd say there's a pretty large range, and that partially reflects the fact that a lot of the banks are counterparties to each other. So let's put it all together. I've told you that there are three things that drive the bases. Now I'm going to run a regression that really compares those different drivers. So you can see I'm going to put the basis, the absolute value of the basis, on the left-hand side. And on the right-hand side, I'm going to have those three measures that I discussed: the safe asset ratio, supply concentration, and demand concentration. Now, I'm going to be looking at the absolute value of the basis to understand the deviations from zero. And I'm going to separate out when cases in which banks are net dollar borrowing versus net dollar lending. And the reason is very simple. We think this is very important, especially for the safe asset ratio, because depending on if banks are net dollar lending, well, now they need to be looking for a foreign safe asset. Whereas if banks are net dollar borrowing, now they are going to be looking for a dollar-denominated asset, which tends to be probably a little bit simpler to perhaps to find. So here's the regression result. We can just look at the second column here. I should mention, it's written on the last slide, but each of these variables are z-scored so that we can compare across them. The way to interpret the first row is that if there is a 1 standard deviation decrease in the safe asset ratio, this corresponds to a 9 basis point widening of the basis. And you can see that the regression shows that if banks decrease their safe asset holdings, or the market becomes more concentrated in terms of the intermediaries supplying dollars, or more concentrated in terms of the counterparties in the market, that leads the basis to widen. So with the last few minutes, I'm going to talk a little bit more about intermediary segmentation, or the role of individual banks' constraints. So we show in the paper that intermediary segmentation is driven by what we think is expertise in managing risk in a market. We show evidence that market shares are persistent and intermediaries specialize in certain counterparty segments. For example, what this means is that if a bank specializes in Canadian insurance companies yesterday, it's likely to today. And lastly, banks hold large loan portfolios in the markets in which they specialize. And what this suggests is that it's not that the trading desk alone specializes, but that the bank across all lines of business specializes in these markets. And now I'll talk a little bit more about how bases reflect specializing banks' risk-bearing capacity, using evidence from the SVB bank run in 2023. So in March of last year, there was the SVB bank run, and there was a large reallocation of deposits. This reallocation was primarily from small banks to larger banks, and our sample is primarily larger banks. So even though there was this reallocation from smaller banks to larger banks, some of the large banks had maybe a very large amount of deposits inflow, and some had a smaller amount. So what we're going to do is exploit the differential impact based on deposit inflows. We calculate a market's value-weighted change in deposits to try and capture how much of a market K's specializing banks are affected by the shocks. So we're looking at the change in deposits weighted by the share of the banks in that market, summed over banks. And this is going to be, this value you can see, this change in deposits is going to vary across currency K and the maturity T plus N. But it's not going to vary over time because we're making these weights fixed to before the SVB run. So the intuition that's going on behind here is that some banks had a very large inflow of deposits and some had less of an inflow of deposits. The banks that had a very large inflow in deposits, their constraints became less binding. And as a result, the markets in which they are intermediating in should be the markets that have less of a smaller basis after the event. So we're going to run a regression to try and capture that. The result suggests that individual banks' constraints matter, and to the extent that deposits are one way in which they get dollar funding, that is shown in SVB. Okay, so we regressed the absolute value of the basis on an indicator for before and after the event, the change in value-weighted deposits, and the interaction between the two. The main coefficient that we're interested in here is gamma 3, the interaction between the two. So here's the regression result. You can see I've highlighted the gamma 3 result here. If we look at the first 3 columns, that's the regression that's listed at the top. You can see there's a very clear, strong, negative, significant coefficient. And what that means is that after the event, after SVB, if there's a 1 standard deviation increase in deposits for a given market, that corresponds to the basis changing by 10%. So we think that this is really strong evidence that individual banks' constraints matter. The markets that have banks that have had a loosening of their constraints are those that see the basis decline. So with that, I'll conclude. So this paper is about several frictions that are important for understanding bank intermediated arbitrage trades. The first is the riskiness in the arbitrage. CIP is risky, so banks don't want to intermediate that trade to infinity. We think that that stems from foreign safe asset scarcity. Second, we look at the role of intermediary segmentation. We show that intermediaries are specializing in markets, and that leads the bases to become inelastic. And third, the role of counterparty risk. We show that a less diverse mix of counterparties leads to larger bases. I think the importance of our work here is that it highlights the role of segmentation and risk in what's commonly thought of as a riskless arbitrage. Thank you.
Now we're going to have Valentina Bruno discussing the paper.
Okay, so last paper, last discussion, 5:15 of the Friday of the long weekend. All right. Well, thank you, the organizers. Sergio, you took it to the next level, as Shabnan said today. Thank you, Tomas. And so let's do it. Okay. So this paper is going to be a relevant paper in the literature, and it's going to get hundreds of citations. And I tell you why. The existing literature looks at CIP deviations and focus on prices. And this study has a cool data set that looks at quantities, bank positions. And so it's able to answer questions, or at least addressing questions that, for which we have suggestive evidence from prices. What is the question asked? What drives the CIP basis? And the answer is frictions. What frictions? Well, scarcity of foreign asset, safe assets, and others. I will focus my discussions today on the first friction, the scarcity of foreign safe assets. So essentially, this is how I see it. It's either you want a dollar, but you can't borrow dollars, and this is affecting the CIP, or you can't invest in foreign assets, foreign safe assets, and this is affecting the CIP. Is it the former or the latter? So Sharon is telling us it is the latter, but I want to be convinced that it's not the former because I want the dollars and I demand for dollars. I'm going to have two main questions, two main comments. The first one is about it's just a big carry trade. So, carry trade is a financial transactions when I borrow currency on low interest rates and I invest the proceeds in high-yielding assets. And here, the crucial markets is the FX markets, FX swap and forward markets. So this chart shows the outstanding amount of FX swap and forwards in all currencies. And the numbers are absolutely huge. This is all off balance sheet, by the way, because we are talking about 100 trillion with the T in all currencies. And what is driving this? So we teach our students, look, is the usual motive. I am an importer or an exporter. I need to hedge my currency risk. I use an FX swap. And that's the blue line. But we see that after the financial crisis, it's the pink color that increases dramatically, and that is the financial use of FX swaps and forwards. So the majority is in the US dollar. You know that 85% of the FX transactions are in US dollar because the dollar is the dominant currency. But who says that it has to be just the dollar? What if I want to do a yen carry trade? I'm going to use FX swap and forwards denominated in Japanese yen. And you also see that these numbers have been increasing dramatically over time. Now, I want to show you this chart. I think it's very, very interesting. Here you see in red the growth in total outstanding forwards and swaps denominated in Japanese yen. And in blue, you have the change in the broad nominal effective Japanese exchange rate index. And the interesting thing here is that the two lines are the mirrors of each other, which means that when the yen is weak, there are a lot of FX swaps around in Japanese yen. Now, think about the following example. I am a dollar provider, let's say a US bank dealer. I give dollars to Sergio. Sergio gives me yen. What do I do with this yen? Well, Sharon tells me I should park it in a safe place. But what I don't want to park it in a safe way, in a safe place, and I sell the yen that Sergio is giving me in the spot market, and I buy Mexican pesos. This is the traditional yen carry trade. And it's not a coincidence that on March 5th, as the yen depreciated a lot, we saw some currencies that suffered the most. And it's the Mexican pesos and the Brazilian real, because that's where all the carry trade, all of this money was going, funded by cheap yen. And there is also another interesting possibility. What if the yen that Sergio gives me, I keep it in Japan, I invest in the Nikkei. I still have the yen, but now I have a risky asset instead of having the safe assets. But I do it because I want it, because I am greedy. No? And so what happens again on the 5th of August? Well, as the unwinding is all going on, we have the largest one-day fall in the Nikkei index, and concurrently is a huge appreciation of the yen. Now, I don't have the data to tell you, oh, this is the smoking gun, but maybe Sharon has it, or supervisory data can tell you. So I'm putting a paper proposal on the table. Comment number 2, and then I will conclude. We have to look at the big picture, because the US banks do not give us the full picture. And I'm going to show you a similar chart to the one I showed you before. But this time we have in red forward and swaps in dollar, and in blue my idol, the broad dollar index, the variable that I love the most. But again, the two are moving together. And this is the broad dollar carry trade. When the dollar is weak, I have tons of FX swaps going around. Now, so Sharon, in her paper, Sharon, you cite Wenjin Du papers and co-authors 22 times, but I give you one more citation on Wenjin work, and I think this is the most relevant paper for that study. And this chart is taken from another paper with Stefan, Wenjin, Catherine, and Yoon. So in here we have the broad dollar index in red and the mean cross-currency basis for G10 currencies in blue. And as you see, since the financial crisis, the two lines are again moving together. And when the dollar is strong, the cross-currency widens the most. Now, we can stay here and discuss over happy hours why it's going over that. And the net interoffice assets is the relevant variable that explains why before the financial crisis nothing, and after the financial crisis we see the cross-currency basis. But I will just give you a flavor of what's going on. And this is all due to This is about the global banking stories with the twist of exchange rates. Essentially, banks are going into a self-funding market, channel the funds and to the regional banks, then lend to corporates that have a currency mismatch. Now, when the dollar is weak, the tail risk is lower, and this creates spare lending capacity at the value at risk constraints. And there is a huge supply. And when the wheel turns, it's the other way. And this is something that we called like a risk-taking channel of exchange rates. So I will conclude with this chart. This chart is taken from a paper which title is Hunting for Dollars. And it's an event study around the quarter hands for outstanding FX swaps positions. And this shows that the increase in quarter-end activity is linked to regulatory-driven demand effects. Essentially, is telling us that the surge in the CIP deviation at quarter end is mostly an European bank story. That's why it's important also to look at the European banks, because the European banks are window dressing their Basel III leverage ratio by cutting back on repos as a source of dollar borrowing and instead going into the FX swaps. I'm gonna skip all the quibbles and I will wrap up. It's a huge demand for dollars. I really want dollars. There is a lot of carry trade going on and risky positions taking. And this is on purpose. I want to make money. I am greedy. And also we need to look at the European banks to understand what's going on the other side. And I'll stop here.
Thank you so much, Valentina. So we have some minutes for questions, or we can just have Sharon answering.
Sounds good. Well, first of all, Valentina, thank you so much for your comments and for the thoughtful discussion. I really appreciate it. So I think I'll address the question about European banks first. So I think it's absolutely important to be thinking about foreign banks. And of course, I wish we had more data on that, but our data does include US operations of large foreign banks. So to the extent that that might help. I think that it's fair to say that global banks and non-bank financial institutions can also play a role in this market. I think that, in thinking about our results, if the way that a foreign bank, if they're executing the CIP trade, the way they might be looking for safe assets in their foreign currency, it might be a little bit easier. It might be harder for them to get dollar-denominated safe assets. And I think that if we're thinking about where are dollars coming from, I think that we're getting a substantial slice of the market, and I say that for two reasons. The first is that I mentioned we have about 25 trillion notional relative to the BIS estimate about 110 trillion. But our 25 trillion is only against the dollar. So it doesn't account for other potential currency pairs. So I think that that's one component. The second thought that I have on that is, so there's a paper that it's by two economists at the ECB where they, I think, also have regulatory data, and it's a paper with Quentin van de Weyer, and it's very nice. They actually show that it seems from their data that a lot of the dollar-euro hedging is not from European banks, but rather non-European banks. So we can only see on our side, a certain extent, but hopefully that helps mitigate it a little bit. I completely agree about the European quarter ends being European regulatory constraints. I think that for what it's worth, our results aren't driven by the quarter ends. We do include quarterly fixed effects, and that net dollar funding measure that I showed doesn't have spikes at quarter ends. So we don't think that our results are driven by quarter ends. Of course, that's very important to think critically about, given what's been documented in the literature. I think for the carry trade, I see your point about what you're saying about if you don't want to park it in Japanese, like a JGB, right? If you want to be doing something like putting in something that you think will yield higher. And certainly if you have done that swap, you can do so. However, by not having it in something that's safe or really close to safe, it's not a true covered interest parity violation then, right? And I absolutely agree that you could take your currency and do something else with it. But it wouldn't be a covered interest parity trade then, right? By the way that the textbook defines it. And I think empirically, the safe asset ratio being so low means that banks who are doing this trade are not perfectly hedging it either, which probably, as I try to show with the convenience yield regressions, might be because the safe asset rate yields are in fact too low. Yeah.
Any burning question? Or? Well, it's 5:30 and I would like to end on time, so thank you very much. everybody for participating. It was a great conference, and I believe next year is in Hopkins. I look forward to seeing you there. Thank you very much, everybody.
Thank you for discussing.
No, I learned a lot.
Okay, that's good.